Good day, ladies and gentlemen, and welcome to our class from Investors Trading Academy. And this is part of our lecture series called Speculate, Invest, and Trade the Financial Markets from the Start to the Profit. This is lecture 5, and we call this lecture Financial Analysis. Now, this series contains 9 lectures. You'll start off learning the basics of the financial markets, and then move on to learning to understand technical analysis and fundamental analysis and how to read charts. From there, we will move on to trading and smart decisions. Each lecture will slowly prepare you to move forward. So please watch these lectures in order. This is lecture number 5. Now, I'd also appreciate it greatly if you would click on the subscribe button or the bell icon down below, because it's important to us to gain our subscribers. We don't email you, we don't contact you. All you get is a ping from YouTube when I upload a new video class. So please subscribe and also comment. It's greatly appreciated. So let's dive into lecture number 5 on financial analysis. And this lecture is a guide to fundamental and technical analysis. Now, we have many other lectures, and today we're going to look at both of these types of analysis, and then we're going to delve into them deeper in future lectures. But we have to start off at point A to get you to point B, to point C, to point D. So we need to make sure that everybody has the same knowledge and understanding as we build your knowledge base. So there are two main types. There are other types of analysis, but there are two main types of analysis. We have fundamental analysis and technical analysis. Now, fundamental analysis also separates or changes by market, because things like company analysis, profit reports, P&E, return on investment only apply to the stock market. But fundamental analysis is basically anything we can read or learn about. Okay, from the news, from the headlines, from economic events to public speeches to media releases. Okay, it's economic conditions, it's future profit, it's sector and individual analysis. Okay, and they're easy concepts to understand. But we have to look a little bit deeper into all of these to understand them in detail, how to use them, and how these can help you make smart investment decisions, smart speculating decisions, or smart trading decisions. And then technical analysis, I call technical analysis chart analysis, because technical analysis is anything and everything we do on a price chart, from just simply looking at a chart to the most advanced mathematical formulas. Whether we're looking for chart patterns or we're looking at oscillators, all of this falls into the field of technical analysis. Now, how do you choose fundamental analysis or technical analysis? Well, most traders like myself and speculators use a combination. Because I need to know what the economy is doing. I also need to know what the political situation or the geopolitical situation is. I need to know what the headlines are doing. I need to know what crazy Donald Trump's doing, or what Iran is doing, or what Saudi Arabia is doing, or what China is doing. At the moment, that will affect the value of either a currency, a commodity, a company share. So I need to be aware. But if I told you that Google was going to release its earnings today and they were supposed to be extremely good, or let's say Alphabet, and they were going to be extremely good, we would assume that Alphabet shares would go up, and especially when they released them and they really were good, we would expect Alphabet shares to go up. Okay? That's fundamental analysis. Even if we went and looked at all the data that was released, all the comments, all the statements, all the editorialization, plus all the numbers. Okay? That is fundamental analysis. But if I told you that Alphabet was trading at 142, this morning it went to 142.44, went to 145, went to 146, 147, came down to 146, went back to 147, came back to 142, and is now trading at 144.50. Well, first of all, Could you repeat any of that to me? No. Could you make any sense out of that for me? No. Could you tell me that the markets have pushed the stock up to the highest level because they expected the earnings to be this good? So that Google topped out at 147 before the release of earnings. So maybe all of that information was already factored into the price. But without seeing a chart, our brains can't comprehend this. Without taking a look at volume, we can't see if the market is pushing the stock up any higher. We also can't determine when to get out of the stock or the investment or the speculation when we are involved in the markets. We need to do this through our charts and other technical tools. Now, if you're an investor, as opposed to a technical analyst, as opposed to a speculator or a trader, you're more concerned with, oh, well, that earnings report is going to eventually push Google up. It's going to be a very good, so their value of their stock is going to go up. And okay, I don't care if I get into it 142.10 or 142.20. I don't care where it went today. I bought it at a good price because I know over the next year it's going to steadily climb. It's going to have its peaks and valleys, but it's going to steadily climb. So technical analysis doesn't really help an investor, although investors still look at charts. And even if you're not using technical tools like oscillators and indicators or chart patterns, you're still reading a chart, looking at a chart, looking for the overall trend of the market. And that's technical analysis. So being open to combining styles may provide the best opportunity to make the most of the market opportunities. Fundamental analysis can be used to identify appropriate targets, while technical analysis can be followed to make smart decisions. Together, these methods can generate a confluence, providing a better investment opportunity than either one used alone. Now, fundamental analysis is the method of evaluating the intrinsic value of an asset and analyzing the factors that could influence its price in the future. This form of analysis is based on external events and influences, as well as financial statements, as well as industry trends. Fundamental analysis is one of the two major methods of market analysis, with the other being technical analysis. While technical traders will derive all the information they need to trade from charts, fundamental traders look at factors outside the price movement of the asset itself. Now, there are various tools and techniques that can be used for fundamental analysis. They can be categorized into two types of fundamental analysis: top-down analysis and bottom-up analysis. Top-down analysis takes a broader view of an economy, starting with the entire market before narrowing down into a sector, industry, and finally into a specific company. Conversely, a bottom-up analysis starts with a specific stock and widens out into considering all the factors that impact its price. The tools that traders might choose for their fundamental analysis vary depending on which asset is being traded. For example, if shares, traders might choose to look at a figure of a company's earnings report, revenue, earnings per share, projected growth, and profits. And we'll look at these events after we take a look at the major economic events. But forex traders may choose to assess the figures released by central banks that allow insight into the state of the country's economy. Now, fundamental analysis is a method of analyzing the financial markets for the purpose of price forecasting. Forex fundamental analysis focuses on the overall state of the economy and researches various factors including interest rates, employment rates, GDP, international trade and manufacturing, as well as their relative impact on the value of the national currency they relate to. Fundamental analysis in Forex is not just about comparing the current data of a single economic indicator to previous data. There are a great number of economic theories which surround fundamental Forex analysis and attempting to put various pieces of economic data in context to make it comparable. Now, the reason we want to break down and understand fundamental analysis entirely and whether no matter what kind of trader you want to be, you have to understand how one event affects the next event. For instance, in the US, we have many different housing reports, major events, but we have what they call new house sales, we have home sales, we have mortgages, and we have building permits. Okay. Now there's a cycle, and when you buy a house, and most people, especially, okay, that's why we have new home sales. When you buy a new home, the sale doesn't technically take place until the new home is built and the papers are exchanged and you take ownership. Now, we can predict if new home sales are going to be good or bad by several things: by home sales, by mortgage numbers, by building permits. Like building permits are pulled by the builder right before he's ready to start building. He doesn't pull them way ahead of time or the day you buy the house. He pulls them in order, especially like in the East Coast where you have heavy winters. There's very little home building, or they don't start breaking ground in the middle of the winter. So you'll see all this pent up demand and all these building permits pulled as soon as the winter is over because the builders want to get into building those homes. The mortgages are applied for at the time of purchase. They're not closed until the house is delivered, but you go to your bank and apply for a mortgage. So all of these steps. So when you want to look and trade, say, a stock that's in construction, you can look at a series of these reports over the last several months and predict what the final housing data is going to be in the upcoming report based on all of those pieces of information. So it's important that you understand from a practical standpoint how all of this works. Okay. There are several economic indicators that financial experts observe because they can provide guidance on the overall health of an economy. These indicators are found in new reports and news outlets. There are some released weekly, there are some released monthly, and a few quarterly. Now, a forex calendar, an economics calendar, keeps track of all these for you. It keeps you up to date. It gives you the daily schedule, the weekly schedule, what month is supposed to be. You don't have to hunt and search for these. They're given to you everywhere. Now, news data arrives every second in the form of price quotes, whereas fundamental indicators are only published once a week at the most. Capital flows gradually from one country where it accumulates at a potential slower rate compared to the countries where it could accumulate at a larger rate. So in other words, ultimately capital flows are going to flow into an economy that is doing better, whether you're going to be buying stock in that country's corporations, whether you're going to be parking your money in the US because interest rates are higher. But all of this is important because the whole world functions on money flow. And foreign investment is a huge amount of money flow. So if the housing market is booming and set to continue booming, a lot of foreign investors will move their money into buying real estate or commercial property, or stocks that handle real estate investments. Following that through, in order to invest, investors will first have to convert their capital into the currency of the country in question. Buying more of that currency will push the demand and force the currency to appreciate. So if interest rates were higher in the US and you had companies like Facebook, Google, these mega corporations have mega amounts of cash and also have big cash flows, moving them back because they have to park their money somewhere overnight, somewhere for the week, somewhere for the month. They're going to park it wherever they get the best interest rate. So if interest rates are going up in the US and not everywhere else, you can see this money flow into the US. Okay. This money flow into the US, they can't take their Japanese yen and get it in interest in the US. They have to convert it to US dollars and put it in the US bank or some account in the US. Therefore, the US dollar will appreciate. Okay, and this is really the basic fundamentals. I mean, we're not going into the ins and outs yet Unfortunately, economics is not always so simple, which is why examples of healthy economies showing weakened currencies are not unknown. Currencies are not like a company's stock. They do not directly reflect the health of the economy. When economic reports are released, traders and investors will look for signs of strength or weakness in different economies. If prior to the news release the market sentiment leans in one direction, changing the price before the release is known as priced in market. It often causes a little commotion upon the actual data. Now, forget investors. Speculators a wee bit, but traders it's very important to. If we expected the housing data based on all of those factors to come in better than at a very high number, but better than what the markets expected. Okay, so if it was a very good number, we would see people before the release pricing in the market. In other words, they would take their stocks that are tied to construction, or their stocks that are tied to retail, that are tied to real estate, or their stocks that are even tied to real estate retail, such as Home Depot. And because when the housing market is booming, it pulls the whole entire sector up, not just individual houses. Okay. Now, if we expected a very good number, and whatever the number was, the market would have priced it in. But if that number then comes in better than we expected or worse than expected, that causes commotion in the market. And for traders, that offers an opportunity because it gives us a short-term volatility and an imbalance in the markets. Conversely, when a market is unsure or the data results vary from what was anticipated, severe market volatility may occur. That is why beginner forex traders are generally advised to stay away from trading around news when practicing fundamental analysis. Now, all of this analysis ties back ultimately to what people predict the central bank is going to do. Okay. Interest rates are a major fundamental forex indicator. There are many kinds of interest rates, but we primarily focus on the base interest rate by the central bank. Because central banks create money. That money is then borrowed by private banks. The percentage or the principal that private banks pay central banks for borrowing currency is called the base or nominal interest rate. So whenever we hear the phrase in the markets interest rate, we're referring to that nominal rate. Now, manipulating interest rates is a big part of national monetary or fiscal policy. And understanding how central banks move, like the Federal Reserve in the U.S., cannot arbitrarily raise and lower rates because Donald Trump would like it or because the stock market is too high. Their mandate only allows them to deal with inflation and full employment. So interest rates, and what they're always looking at is jobs growth and inflation. Their mandate requires them to try to maintain inflation at 2%. But things like jobs growth and inflation cannot be changed or accelerated, decelerated instantaneously by changing the rate. And we can't ultimately change the value of the dollar or drive everything crazy in the U.S. So the Federal Reserve is always looking way down in the future because they're also not concerned with blips. And so we look for them for guidance, but we're looking at every bit of data released today as investors, traders, and speculators to try to predict what the central bank is going to do at their next meeting or the meeting thereafter. And they can have an impact on inflation, investment, trade, production, or unemployment. So the central bank generally wishes to boost the economy and reach a government-set inflation level so they can decrease interest rates accordingly. This stimulates borrowing by both private banks and individuals, as well as stimulating consumption, production, and the economy in general. Low interest rates can be a good tactic, but a poor strategy. Now, we were talking about money flow and foreign investment. If the economy is doing well, but inflation's getting high, the central bank has to do something. And when the economy is good and running extremely well or better than good, we tend to get inflation. So the central bank will increase its interest rate. that brings money flow in, which is the opposite of what they want. But it also raises the cost of things, so we get a deceleration in sales, and we can put a curb on inflation. On the other rate, at that time, we also then bring in more foreign investment because interest rates are higher. The reverse scenario is also true. Okay, if we lower the rate, that's very good for corporations. Lower rate, corporations will borrow more, they'll expand more, they'll buy more product, do more investment because their investments cost less. And we're talking about capital investment because it costs them less because the interest they have to pay is lower. That causes a growth in an upswing in another sector, but also foreign investment runs away because our interest rates are too low. So it's all a two-edged sword. In the long term, low interest rates can overinflate the economy with cash and can create economic bubbles, which is, we know, sooner or later will burst. To avoid this, central banks can also increase interest rates, thus decreasing the amount of borrowing and leaving less money for banks, businesses, and individuals to play around with. And as mentioned, inflation, and why we're always looking at CPI and PPI. Those are the inflation rates, Producers Product Index and Consumer Product. This is the price of the goods are increasing either on a consumer level or the price that goods are increasing in cost to the producer. Okay. And all of this is an indication of what the economy is doing and helps predict what the Federal Reserve will do. Too much inflation tips the balance of supply and demand in favor of supply, and the currency depreciates. The converse is also the other side of the coin. Then we have gross domestic product. Okay, it's an overall indicator of how the overall economy is doing. And then we have the jobs report. Jobs report is very, very important because one of the mandates of the central banks, and it's how many people not only are just employed, how many people are unemployed, what the unemployment rate is, and it goes farther than that. It looks at salary levels because you can have a lot of people employed, but salary levels are down. Or you can have a lot of people that are employed, but they're losing hours. So when hourly hours per week are reducing, then we have a problem because what happens is the companies feel a surge and their revenue is lower, their earnings are lower, they have, their profit margins are falling. What do? They start cutting overtime. They start cutting people's hours back. So it's all wrapped in here, but we need to evaluate this under fundamental analysis to understand what is happening with the currency. And then we have private reports outside of government reports like Purchasing Managers Index, which is a very important report that's released around the globe, PMI. And the Purchasing Manager Index is an index of prevailing direction of economic trends in the manufacturing and service sector. Okay. But hidden in this report are other pieces of information that might pre-tell us what the GDP is going to do, what retail sales are going to do, because the purchasing managers are the first people to start seeing shifts in the quantity of goods they have to the quantity of goods they have to repeat to how much raw material they have to buy. And so this might give us a first piece of information. So all of this is wrapped together. Interest rates, inflation, GDP are the three main economic indicators used in forex fundamental analysis, but you have to look at them all. Economic indicators are not only measured against each other through time, but some are also correlated in cross-discipline and cross-borders. Fundamental analysis helps traders and investors to gather the right information to make rational decisions about what positions to take. Okay. Now, I think we spent enough time just talking about the basics of fundamental analysis. Because like I said, we have another whole class in just breaking all this down and seeing how it works together and what numbers you would evaluate in each report. So now we come to technical analysis. And as I mentioned in the very beginning, I call technical analysis chart analysis because it's anything and everything you do on a price chart. Technical analysis is the study and use of various charts and other technical indicators to make trading decisions. Using past price and volume data Also known as market action, technical analysts try to predict future price movements. The action of market participants can be visualized by the means of a price chart. Therefore, that's why I call it chart analysis, and patterns can be observed therein. The job of technical analysts is to identify these patterns and develop a point of view. This analysis particularly helps to generate short-term trading plans. You cannot trade in a short-term market, okay? You can invest without any technical analysis. You can speculate without any real technical analysis, but you can't trade without technical analysis. Believers of this approach do hold positions for a short time span with a view to capitalize on opportunities created by price fluctuations. Because all we are looking for in the short-term market, speculators and traders, is short-term price volatility or fluctuation change. We don't really care in this type of, using this type of analysis, we don't care really about the company's producing a new product and those new iPhones should be the best in the world. They should outsell everybody, or this competitor, I'm bankrupt. We don't care about the individual breakups of in a commodity. We don't really care about how big the harvest is going to be. If there's a strike in Brazil, so orange juice is going to go up. We care about the short-term movements in price. We don't really care what generates them. Okay, because all we're looking to do is make profit between price A and price B in the short term. Hence, we're speculating or trading because we really don't have an investment in the actual asset. Technical analysts observe support and resistance levels to identify points on a chart where a pause or reversal of a prevailing trend is likely to occur, to decide the entry and exit point for a particular investment. There are too many types of charts and techniques used for technical analysis, each serving a distinct purpose. For example, line charts, bar charts, candlestick charts. Okay. But these are the three most prevalent types of charts. Now today we're going to touch on them in about a second each, because we also have an entire lecture on the different types of charts and how to read charts. So let's talk about some technical analysis basics. Now, given that technical analysis focuses on price movement, volume, and trends, there are several basic aspects and charts that technical analysts look at rather than like looking at financial statements such as fundamental analysts do. First is price. A technical analyst is always looking at his price on his charts. That is the most crucial of all points. It's the biggest factor. Okay. In fact, price action is the primary measure considered when conducting technical analysis. Technical analysts start by examining charts that show a security's price and trading volume to notice historical performance and help predict future movements. The basic function of using charts to examine stocks and other securities is to identify trends in the investment price or trading volume and how those trends can change over time. Now, if you believe, like I believe, that price is the ultimately important factor, but price is completely random. It's made up of decisions by millions of human beings all around the globe doing whatever they want to do. Therefore, price is always random. But there are certain times in which price exhibits a non-random behavior. This non-random behavior could be called trends. When we can see or find a period of this non-random behavior, we can apply some values, some analysis, some strategy to make and predict where price is going to go and where to buy or sell an asset and how it should move. Okay. And these non-random times are known as trends. And we only have three types of trends. Price is either moving up steadily, price is moving down steadily, or price is moving congested and sideways. So as the bread and butter of technical analysis, Chart patterns are one of the main ways analysts examine and predict where a stock or security will trade down the road. Now, one of the most important parts of a chart for technical analysis is called a trend line. Okay, uptrends, downtrends, sideways trends. Now, a trend line is slightly different than a trend because a trend line has a set of rules about how to draw it. Because we have to remember, price doesn't move in one direction. It may be moving upward, but it moves in peaks and troughs. Push and ease, push and ease, push and ease. But you have to be able to see that the price is steadily moving upward. While charts look very mathematical, they're really based on plotting and giving a visual representation to investors' emotion and market psychology, depicting moves in price over time. Volume, especially in the stock market and commodities market, is very valuable because if you see a trading opportunity but you don't see volume increasing, it means the other traders around the world don't see that opportunity. Whenever you see volume increasing or decreasing dramatically, you should be analyzing that chart to find out if there's an opportunity also. For technical analysis, looking at volume of a stock or security can help analysts determine the strength of the price movement or the trend by showing the number of shares being traded in that direction. And as I mentioned, trend lines and trends. For a technical analyst, trend is perhaps one of the most important indicators of a stock or security. Technical analysts prize examining historical trends to forecast what a historical price might do in the future. For this reason, human behavior and emotion play a surprisingly key role in technical analysis. Patterns of trading and price movements from the past often indicate how the security or the stock behave in the future. Okay. Now we keep referring to historical. If you're looking at a price chart of gold and you're looking at a gold chart that's covering the last 20 years, you're going to see that gold over the last 20 years has climbed steadily. Now, if you look at it in smaller segments, you can see there was price where it dropped and price where it came up. But, if you were a rich family and you bought $1 million worth of gold in 1980 and put it in your vault, because the wealthy, the hedge funds, they're not looking to make huge amounts of money. They want things that are steadily going to increase. And if they would have put that gold that they bought for, 10, 20 years ago for $386 in their vault, and today is trading at $1,650, well, that was a nice, if you analyze that profit, that was way more than the banks were paying you on your money. So you did very, very well. In addition, trends have various lenses that analysts use to interpret them. We have short-term trends, which are more applicable to traders and speculators, intermediary terms, and long-term trends. So just like I mentioned about gold. In a long-term trend, gold has been trading steadily upward. In the intermediary, over the last several months, gold has been trading upward. But maybe in the short term, gold has been trading downward. So we would want to know this by looking at historic prices to understand the environment in which gold, if gold was moving steadily upward and dipped lately, okay, you would know the overall pressure on gold is to move back up. Okay. Where if gold had been falling steadily and then fell a lot more drastically over the last couple days, the market is helping push gold down. The overall opinion of gold is to come down. So assets can experience different trends in the short term, while still experiencing growth in the long term. And then we want to look at things like momentum. Momentum is the speed at which prices are changing. And then support and resistance. Now, like I mentioned, I'm a chart pattern trader. I trade from price action, chart patterns, and support and resistance. Now, support and resistance are not a difficult concept. They are in a concept that requires you to look at historical prices. But let's say you see this building and you step into the elevator on the ground level. The floor below your feet is your support. The ceiling above your head is your resistance. When that elevator starts moving up, you have to keep breaking through each ceiling. That ceiling becomes the floor under your feet or your support, while the next ceiling becomes your resistance. When that elevator reverses and you're trying to come down, it just reverses. You got to break through that floor to get to the next ceiling that's your support level, and then break through that floor, that's the floor below your feet, which is your resistance to get to the next level lower. Now, by observing the historical movement of this elevator, let's say you're in a 5-story building that has a roof deck, which is a smoking deck, lunchroom for all the employees in the building. It's got tables and chairs and outside balconies to smoke. It's got vending machines. Okay. The third floor has got several conference rooms in it. The first and second floor are the offices, they're professional offices for all those people that, for all the people in the business that's operating the building. The lobby floor is the main floor, plus it's full of retail. If you watched that elevator going up and down the floors that it stopped on throughout the day and then yesterday, and you looked at the different times of day, and you saw how often, once the building opened in the morning by 9 o'clock, not open, but started getting busy by 9 o'clock, most of the time the elevator ended up at the roof because lots of the smokers were going up, people going to buy coffee were all going up to the roof, the employees. Lunchtime, that elevator most likely stopped at the roof. Okay. So you know what to expect or predict by looking at previous price movements, historic price movement. So you could predict tomorrow. You also know after 8 o'clock that elevator usually doesn't go, if that elevator goes up to 1 and stops, it's most likely going to come back down to the ground because there are few left employees going home, or that those few employees left are going up to the roof to smoke. Most likely it's not going to stop on the conference room floor. It's not going to stop on the second floor or the fourth floor because there's nothing going on there. So support represents the price where demand for a stock is high enough to typically prevent the price from dipping below that line. Conversely, resistance represents the point where sellers of a security will come in to dump their trades. Now, how you look at charts and find support and resistance are in our other lectures when we're actually going to look at these and be drawing them on charts and understand how to incorporate it in trading. Support and resistance levels are extremely important in identifying trends and where they might reverse. Then we come over to what a lot of people think is all technical analysis, and that's the sector that's indicators and oscillators. So apart from just resistance and support levels, technical analysts also look at some key indicators like money flow, volatility, momentum, and more to get mathematical views of how a stock or other security might move. Indicators are calculations based on statistics like price and volume that help confirm chart patterns and other trends. They're designed to create buy and sell signals that help traders and an analyst determine where to make the best investment or exit a trade. Now, indicators simply indicate. So keep that in mind. Indicators indicate. And they're also the interpreters of price action. When you're looking at price on your chart, you're looking at the other things that you do on your chart, trend line, support, and resistance, and you can't really draw a conclusion. You can think of the indicator as the interpreter. It will help you define your opportunities. So by examining these indicators, analysts can better confirm a stock's price movement and therefore the validity of a specific chart pattern that experts think they're seeing. Now, some of the indicators are also oscillators, or tools that function by showing short-term overbought and oversold conditions of stocks, securities, commodities, currencies. Oscillators are typically bound in a certain range. So we've broken down, we have fundamental analysis that understands patterns in a company's financial performance and tries to predict future performance using financial statements, where technical analysis understands patterns in a company's price share and assumes historical patterns in price shares would repeat in the future. Okay, now I mentioned briefly that we separate stocks out. Okay. Stocks, we look at many different factors to determine what's going to happen. We look at profit after tax. We look at profit margins. We look at revenue. We look at return on an investment or return on equity. We look at the PE ratio, or the price per share, or earnings per share. And we look at the PB ratio, which is price per book. So one of the basic and crucial aspects of a healthy stock picking is carrying out fundamental analysis for a particular company. So there's many ratios that we should look at. So we want to look at price earnings ratio, or PE ratio. Now, however, earnings of a company can be hard to predict as they are based on past performance and expectations. Also, the PE ratio doesn't factor in earnings growth. We look at earnings per share. Earnings per share are calculated by dividing a company's net income by its number of outstanding shares. And we look at price to book value. The price to book value ratio measures whether a stock is over or undervalued by comparing the net assets of a company to the price all of the outstanding shares. This ratio shows the difference between the market value and the book value of a stock. And price per book value, or PB ratio, the market value is the price investors are willing to pay for a stock based on expected future earnings. The book value, on the other hand, is derived from the company's assets and is a more conservative measure of a company. Value investors often prefer companies with a market value less than its book value in hopes that the market perception turns out to be wrong. And then we look at debt to equities ratio. The debt equity ratio shows the portion of equity to debt that a company is using to finance its assets. When a company is using a lower amount of debt for financing, it will have a low debt equity ratio. And then we look at free cash flow. That's the leftover cash of a company after it's paid off its operating expenses and capital expenditures. It shows the efficiency of a company at generating cash and is considered as an important indicator in determining whether a company has sufficient cash to reward shareholders through dividends and share buybacks. Free cash flow can be an early indicator to value investors' earning may increase in the future. When a company's share price is low and free cash flow is on the rise, the earnings and share value of a company could soon be heading in the upward direction. So as you can see, it's different types of fundamental analysis, which really the overall fundamental analysis does apply to companies, but then each company has its own economics data. So if you think of a earnings report as the economics data for that company as opposed to a country. So that's a wrap for today, folks, and we'll see you in lecture number 6 when we're going to start breaking down all of this so that we can start looking at making smart investing decisions, speculating decisions, or trading decisions. So thank you very much for joining us, and please subscribe.